Hi, Adam. How are you? So nice to see you.
Thanks for having me, Bogomil.
So I know you're getting ready for your vacation. It's one of your last commitments before you go. So I told you,
That's right.
let's make it feel
Uh,
like vacation already and
that sounds good. That
not take
sounds
it too
good.
seriously. Although
Sounds good.
the topics I have in mind are pretty serious, but let's take them a bit lighter today.
Well,
I
it's
want to
okay. I've studied these topics for many years, so I can do this even in my sleep. So I'll be fine.
You'll be fine. I love the sound of that. Well, let's jump right in. I like to start those conversations with those early days, if you indulge me. And I ask my guests about their childhood and upbringing and how they think that time influenced them, shaped them, and led them to the career path that they're on today. The investment world, in your
Hmm.
case, our case.
Yeah. Well, in some ways, I was raised not to be in the money business. Both my parents worked at nonprofits. My dad worked for a long while at the Ford Foundation, which was and still is giving away Henry Ford's fortune, and my mom was a social worker. So money was always kind of a dirty subject in our household. We didn't admire business people. We didn't think about the stock market. I mean, I remember hearing the stock market quote on the radio when my mother used to listen to WQXR classical radio, and it was just sort of a mystery to me what that meant. So I was not trained to be a money guy, but on the other hand, I was trained to be an analyst. My parents loved to read, they loved academics, and they really instilled in me, great analytical discipline and rigorous inquiry sort of spirit. Um, so I majored in liberal arts in college, and I always wanted to be a journalist, so I could take my analytical skills and my curiosity and get paid for it. And I was a journalist for the first 10 years of my career, much of it as an investigative journalist. I got people in trouble and righted wrongs and felt really good about it. But when I was turning 30, I said, the money's horrible, the hours are horrible. And I had friends who'd gone onto Wall Street, and they said, Adam, being an analyst is just like being a journalist, except to a different end. As a journalist, you're trying to find the truth to help society. As a money manager, you're trying to make money for yourself and for your clients. And so I went onto Wall Street in 1995, started with Sanford Bernstein, which was a great way to begin. And I quickly realized that my friends were exactly right, that investigative journalism and investment research are, I have to say, almost identical. We can get into it if you like, but for now, leave it that it's no accident that Warren Buffett has said that if he weren't an investor, he'd be a journalist because the skill sets are the same, and the process of inquiry and discovery are the same. So my background helped me with process of inquiry or discovery, but not necessarily with a specific way I'm using it.
It's fascinating because I met a lot of people that had career in journalism and then became analysts and money managers, and they realize
Yeah,
how relevant the skills are in both fields.
yeah, yeah. I wouldn't say a lot, but enough. Yeah, fair amount.
Quite a few that I come across, and I find it fascinating. I was thinking the other day, I mentioned on the show how Peter Lynch's book One Up on Wall Street was the first book that was really about investing that I read. And I was wondering why I got into investing. And it wasn't really to make money. I was really seduced by the intellectual pursuit of figuring things
Yeah,
out and making sense out of
yeah,
things. And then there's the
yes.
financial money context that if you're right more than you're wrong, then you'll make money. And but that wasn't really the
Yeah.
main reason why I got intrigued
Well,
by it.
well, that's good. I thought that I was the opposite. I thought that when I went onto Wall Street, I would make a lot of money, but it would be boring. And this was my background talking.
Uh-huh.
I didn't think much of Wall Street. But as I got learned, and especially the discipline of value investing, I learned that there was an intellectual history associated with Wall Street. and you could do everything you wanted in terms of investigative reporting, but the money was a million times better. So I've
Hmm.
quite enjoyed the trade-off. Although, as you know, I've recently gone back to my first profession and started writing again, which is really fun to fuse the my first career with my second.
Well, I have to ask you about that, about your book. So I love the title of the book, and I mentioned to you that it's a different book. And I'll mention more throughout this conversation why I like it. The title is Where the Money Is, Value Investing in the Digital Age. And you write how you focus on the digital economy not because it's sexy, interesting, or beneficial to society. You did it for the same reason Willie Sutton robbed the banks. It's where the money is. Tell me more about the inspiration for the book. It's such a playful way of addressing a
Yeah.
fascinating topic.
Well, the book was really born out of my own personal struggles with trying to figure out what the heck was going on and is going on in the early 21st century. So, like a lot of value investors, I was schooled as a classic, value investor, especially at Bernstein, which is a very, what they call a deep value investor, where you think about reversion to the mean and cheap PE and cheap price to book. This, of course, was what Graham gave us more than 100 years ago. And it was really a wonderful invention because prior to that, Wall Street was a casino. And
Mm-hmm.
this was a discipline, this was a rigor, this was an intellectual construct to help you systematically make money so that it wasn't an accident. And when I started my own firm in 2002, I did deep value investing. I wasn't so interested in really great businesses. I was interested in cheap businesses. And I did really well from 2002 till about 2014, weathered the financial crisis well and so forth. It was coming right out of the dot-com bust, so I had avoided that. And then around 2014, my all my tried and true methods basically stopped working. Reversion to the mean stopped working. Low price to book stopped working. Low PE largely stopped working. And so I really had to search my soul because it's one of these binary questions. Either the market is temporarily wrong and we'll go back to these things working, or something fundamental has changed in the world and the methods that I've used so successfully no longer apply. And I concluded that the latter was the case, that, with the rise of the digital economy, there were new rules and new laws, so to speak, almost like physical laws of finance were changing. And companies like Alphabet and Amazon that had looked expensive all the way up were, were, were still going up despite remaining expensive. So there again, that fact, the fact that so many tech companies had gotten so big so fast and had gotten so valuable so quickly, presented me as an investor with sort of a binary decision. Either they were so overvalued that it was going to make the dot-com bust look like a tea party, or they weren't really overvalued. They just looked overvalued using these old value-based lenses. And if the latter was true, then we needed to change our lenses. We needed to evolve value investing to incorporate the new realities of the digital age. And so I decided that the latter was true, that these companies were extremely valuable. They just didn't look valuable on traditional metrics. And
Mm-hmm.
so I, as an investor, had to evolve. So I started evolving around 2016, 2017, and started to do really well. And then COVID hit, and I had a literary agent who had read some of my work in Barron's and Fortune say, "You should write a book." I said, "I don't want to write a book." But then COVID hit, and I couldn't travel and I couldn't research companies, which is an integral part of what I do. And so I said, well, why don't I just sit down and write down what I've been thinking? And so
Mm-hmm.
that's a long way of explaining how the book came about.
To me, the essence of it is that investing, value investing, if you want to label it, is subject to change. And in your book, you take us on a journey of evolution of what we consider value investing from Graham to Buffett and beyond. In my own professional experience, I've been in the business 20 years. And when I started, I worked with some people that were towards the end of their career, but they are new people that remember the Great Depression. So there was this continuity of intellectual heritage passed on, of stories and tales of what worked. But the awareness that you bring up to the table today is that some things just stop working. And we have to keep on reinventing the wheel in a way. Can you talk about that journey from Graham to Buffett and the last decade or two, I would say, even beyond?
Well, I really enjoyed writing the history of value investing, probably because of my liberal arts background. Um, and many people have told me how much they enjoy the history in the early chapters of the book before I get to the meat of the book, which is, how specifically should we value these tech companies? If they look optically expensive, how should we get comfortable with their valuation? But the history of value investing was really fun for me to write, and a lot of people like you have said how much they liked it. One person said you really explore the cultural aspect of value investing, which is
Yes.
true because Wall Street is a culture and value. If you ever go to the Berkshire Hathaway annual meeting, you will
Mm-hmm.
see there is a culture of value investing.
Mm-hmm.
And value investors tend to be sort of curmudgeons and sort of stingy and set in their ways. And, a lot of that is good. So, as I said, Ben Graham was a child of the Depression. He
Mm-hmm.
was such a brilliant guy. He could have taken professorships, I think, in 3 different departments in Columbia when he graduated, but he had a family to support. His father had died and his mother needed support. So he went on to Wall Street to make money. And he said, this is crazy, this casino-like atmosphere. One of his early jobs, as I say in the book, was taking bets on the 1916 presidential election. That was legal for a New
Right.
York Stock Exchange firm to function as a bookie, essentially, on the presidential election. He said, this is nuts. I don't want any part of this casino atmosphere. I want to figure out a way to systematically make money. So he came up with a very quantitative, balance sheet driven approach, which focused on assets and liabilities and sort of a burn down analysis. If this company goes belly up, will I still be okay?
Right.
And he didn't anticipate the Great Depression, but he was a creature of booms and busts because the American economy back then was still quite underdeveloped. So this worked quite well for him, and then it worked especially well in the Depression, when a margin of safety, a numerical asset value based margin of safety really, really mattered. So he did pretty well. And then he taught at Columbia Business School, and his star pupil of 1951 was Warren Buffett.
Mhm.
And Buffett revered Graham for this intellectual framework because Buffett himself was looking for a framework. We're all looking for frameworks. But as Buffett's career went on, especially influenced by the late Charlie Munger, he said, the world has changed from Graham's day. We won World War II. We're the post-war power. American economy is much more stable. Yes, we have recessions, but we don't have huge booms and busts like we did in the first part of the 20th century. We now have, thanks to the Depression, the Securities and Exchange Commission, which Graham helped create. We have GAAP accounting. We have standards, so you can rely on financial accounting. You can rely on financial statements. And he said, it's not so great to look at just the downside and the liquidation value of a company. Let's look at the upside. Let's look at their ability to generate earnings going forward
Mhm.
uh, as a franchise. And so, especially influenced by Munger, who said, this cigar butt investing is for the birds. Let's buy good businesses at fair prices and let them run. And so that's value 2.0. Graham's system was value 1.0. And look, Buffett is the greatest investor ever. He remains the greatest investor ever. His biggest holding is now Apple, which is technically a tech company. But, there's important subtle things, not so subtle, but difficult to articulate things that he has, because of his worldview and because of when he grew up, similar to Graham, are a little outdated and need to be changed, need to be evolved. And that's, my so-called value 3.0, which I highlight in the book.
So, a couple thoughts to come to mind. Let me start with Geico. I want to bring up Geico for a brief moment.
Oh,
So,
yeah.
Graham, in the last chapter of The Intelligent Investor, later edition, I believe, he mentions how he spent his career picking the cigar butts that you talk about, but he made more
Yeah.
money in one single stock. And it's such a great
Yeah.
moment of self-reflection and awareness where he realizes this style worked for him so well for so long, yet he made one decision that he discloses that broke most of
Yeah.
the rules that he had. It was a quality
I would
business.
actually disagree with you, Bogomil.
Tell
The
me.
old investigative reporter in me would note that
He did
Graham
more of those.
Graham wrote this. He
Uh-huh.
wrote this. He admitted that one stock, Geico,
Uh-huh.
had made all more money than his 20 years of, buying something for 60 cents on the dollar and letting it go from 60 cents to a dollar.
Right.
So all those cigar butt investments combined
Uh-huh.
didn't make as much money as one great company stock, Geico. So he admitted it, but he
Uh-huh.
admitted it in a footnote.
Uh-huh.
It was not prominent. He admitted it in a footnote, and he wrote about it in the third person. He said something like,
That's true. Mm-hmm.
"It's so interesting. I'm familiar with an investment firm whose
Uh-huh.
partner, and he and his partner, he didn't even say it was me."
Uh-huh.
So, the old investigative reporter has to say, cry BS on that one.
I
He admitted it extremely indirectly and obliquely. Um, but and very few people talk about it.
uh-huh.
Very few people talk about how Geico, his one investment made more money than all the cigar butts combined. I mean, that's a dramatic fact and a dramatic insight, and it's one that Buffett gradually internalized over time. And of course, in 1995, he bought Geico, 100% of it. So,
But somehow Graham felt obligated to put it in the book. It could have remained a
sure.
footnote
I mean,
in a drawer.
okay, he put it in. He put it in, but sorry, it was not. It's not what we would call fulsome disclosure.
No,
It
no,
was
it
not,
wasn't. But part of him just couldn't keep it a secret. He had to say it. That's why I know you're
I
right. It's
I
in the third
guess
person. It's a footnote and you can miss it. But for those of us that actually read those books back to back, many of my friends, and I'm sure, well, I hear that you found it too. So people know about it. So he put it in there for
that's
us to
true.
unearth it.
Well,
But you're
you're
right
you're
that
you're taking you're taking the glass half full side, which I admire, which I admire.
the other thought that I had was looking just at Berkshire for a second, Buffett's vehicle. I had Adam Mead on the show who wrote the very detailed history of Berkshire. And the initial capital that really funded Berkshire, the textile business, over 100 years ago, came from the whaling fortunes of the Northeast. The reason I bring it up, I work with families that have had money for over multiple generations, and I'm always fascinated how the capital travels from generation to generation. It might have been one business that created a wealth. It's a portfolio of businesses that will keep it and grow it. But those businesses continue to change. And that's the essence of your book, that the businesses will continue to change. And look, we went from a whaling fortune that funded the textile industry that went away. Buffett discontinued with, I think, it wasn't easy for him, but he ended up just stopping those businesses, ending those businesses. All the way, what you brought up, which is Apple. I mean, how far we've
Yes,
come from
yes, indeed,
whaling
and
fortunes
that's
that,
the beauty of capitalism. Yeah, that's
right,
the beauty of
isn't it?
capitalism.
And
Is it moves and shifts and changes, and it's not static. It's not run by a 5-year plan or a 10-year plan like in authoritarian regimes. It's responsive to changes in the world. Yeah, it's
and
lovely.
if you pull on the thread, it goes all the way through history, and it's somehow connected. It might be not the same people owning the business. Obviously, it's not the same people running the business, but it's somehow connected through history, right? The big
Yeah,
shareholder of
yeah.
Apple
I,
being
I, I like that. I like that part of it.
right? Isn't it fascinating? And when you think about family fortune, you want to figure out how it can last a century or more, which is a big, big ask. You talk about the mean reversion.
Yes,
Large fortunes over time diminish. What is it that you can do
yes,
to continue to reinvest it in bigger, better
yeah. You have to
businesses over
continue
time?
to adapt. And, that's why Bezos at Amazon is so great. He says, we will one day be Sears.
Yes.
Sears made two incredible pivots. They were the first mail order business.
Right.
So the Sears Roebuck catalog was dominant for, I don't know, a couple generations. And then in the 20s, they saw that the automobile was coming and they pivoted away from the mail order business and they went to the retail store network.
Mm-hmm.
Um, so, hats off to them. But, within 100 years, they were bankrupt. Um, and so Bezos keeps telling his people, we will be Sears, we will be Sears, we will be obsolete, we will be co opted one day, which,
Uh-huh.
of course, you know, postpones that day every time he says it because it requires, it compels his people to be hyper vigilant and always changing, and so he had the retail e-commerce, then they started AWS, and that's if anything a more valuable business now than the retail e-commerce network. So very important to keep innovating. Yeah, and that's really one of the signature qualities of tech companies, Bogomil, and I think that's something that Buffett misses
Uh-huh.
is see Buffett came of age in the 50s when the American economy was maturing and then matured. So, there were three television networks, for example, when he was in the late 20th century. In the late 19th century, I think there were 100 newspapers in Washington, D.C. By 1970s, there was one newspaper, and he bought as much stock as he could. So you know, he understands sort of static warfare. If we can compare business to warfare, which there are a lot of analogs, it's civilized warfare. And he wanted companies that were firmly entrenched, television networks, newspapers, Coca-Cola, that had, they had competition perhaps, but it was lesser competition than the big dogs that he owned, and the rules were drawn. You weren't going to build another Coca-Cola. You weren't going to build another Washington Post. You weren't going to build another ABC television network.
Right.
So this was the era, and this was the gestalt in which he was immersed in.
Mm-hmm.
So when the tech boom comes, and all of a sudden there are all these disruptors, it doesn't compute in his head. You see, uh, he said, "Oh, I looked at Google, but I couldn't determine whether they were better than Alta Vista or all the other competitors." You see, so he wanted to wait
Uh-huh.
until it shook out, and that explains why he bought Apple, because in many ways Apple is not a tech company so much as it is a consumer products company.
Mm-hmm.
People have standardized on their iPhones, right?
Mm-hmm.
To rip yourself out of an iPhone makes it look easy to rip yourself out of your bank, which is
Mm-hmm.
another one of his favorite investments, right?
Mm-hmm.
So, and Apple is much less ambitious than, say, Google or Amazon in terms of reinvesting their capital in the business. They have huge share repurchase program, right?
Mm-hmm.
And he loves capital return because here again, his mindset is, I want a stable business that's dominant and that can just grind things out for a
A long
generation.
time.
I don't want them reinvesting the money. I don't
Mm-hmm.
want them reinvesting money. And that playbook has worked very well, and certainly he's done extremely well with Apple. But I think it leaves a hole in your worldview for companies like Amazon, for example, which are highly ambitious and which and reinvest their capital. And listen, they understand return on capital every bit as much as Buffett.
Mm-hmm.
Bezos started his life at a hedge fund.
Right.
He just knows that a dollar invested today in Amazon will likely lead to two, three, $4 down the road. So I don't care, he says to himself, if it affects the income statement. I'm going to reinvest now because it's net present value positive.
Mm-hmm.
And Buffett misses that. He misses those things.
Adam, you propose a formula in your book that I want to bring up, and it made me really pause and think about opportunities. Now, I have this idea of what kind of a stock would you hold for 20 years? Whenever I give a talk and I bring it up, people give me companies that will be around in 20 years. And I say, that's not what I'm asking. I'm asking about a company that's worth holding for 20 years. It's worth the wait. And reading your book, it made me realize even more what kind of company it is. You look for companies with a low market share in a growing market. I'm going to repeat that: low market share in a growing market with a
That's
durable
right.
edge and an
That's
exponential growth potential. So
yeah.
these are some powerful elements there that don't rhyme with the Apple purchase so late by Buffett. It doesn't,
That's right.
right? You
He,
already
he,
have a
he wants
dominant.
he wants mature. He wants
Yeah.
businesses that have gone through the competitive ringer, that have emerged victorious and are sitting up there on the top,
Hmm.
and it's very hard to topple them. That's what he wants.
You want to be
Um,
earlier. You want to be
I'm
much earlier.
I'm a little more ambitious, I guess. I want companies that are earlier in their growth cycle,
Hmm.
but still have that competitive edge. I mean, in some ways, I want the best of both worlds. I want companies with,
Right.
as you say, a low share of a
Hmm.
large and growing market and an edge.
Hmm.
So I'll give you a couple of examples if you'd like. Neither of them are tech, although one uses a tech. One is effectively a tech company, but Heiko, which I write about in the book, is this aerospace manufacturer. They make generic parts for replacement parts on commercial airlines. So before anyone freaks out, every part has to be approved by the FAA. And Heiko struggled for a decade or so to get the FAA's confidence, but they finally did, and I think they've had 85 million parts in service with no incidents. But what happens, Bogomil, is these GEs and Honeywells, they rip off their customers in the replacement market. They rip off the airlines in the
Right.
aftermarket, and they charge enormous premiums for their parts. So Heiko said, "Hey, we can make parts 30 to 40% cheaper and still earn good returns." So that's what they do. 30 years later, they've compounded revenues at, I don't know, 19 or 20% per annum, but their market share is only 2% of the used replacement aerospace parts market. And the aerospace parts market itself grows about 7% a year. So they have a tiny little 2% sliver of a pie, the pie of which is growing 7% a year, and they charge 30 to 40% less than their competition. So I would say that fits the definition of a company with a low market share
Hmm.
in a large and growing industry and a competitive edge. Every year the GE and Honeywell raises prices 10% a year, and Heiko raises prices 3 or 4% a year. So every year their price differential widens, and every year Delta and United and the rest call them in and say, "Hey, next year would you do this part, that part, this part, and that part on the plane?" And Heiko says, "Sure." So that's a great one. And then the other one is actually Bears on Geico. It's Progressive, which I bought this summer. It wasn't in the book because I didn't own it, but they were having under short-term earnings pressure because this inflation that we got hit with really played havoc with the repair market for autos. So they were their claims were spiking, and they weren't able to take pricing up fast enough. Um, but I studied Progressive and I realized that they actually now have a cost advantage over Geico,
Hmm.
not in their selling cost, because Geico sells 100% without agents and Progressive's only 50% without agents. But they've used technology, Progressive, so intently for so long, for a generation, that their loss costs are actually 1,100 basis points better than Geico's, precisely because they can look more granularly at your driving history, my driving history. They can predict whether I'll have an accident. They can install devices with my permission if I'm a safe driver to give me a discount. So they're much more granular in their underwriting of risk,
Hmm.
and so they're actually the low cost producer of auto insurance, and they've taken a lot of share off of Geico to the point at which Geico is really scrambling to reinvest in technology. Um, but Progressive's market share is only 12%. So they have a fairly small share of a large and growing market. The auto market grows, I don't know, 4% a year, 5% a year, population growth plus price. And they have an edge because they've used tech and Geico, which, here's Buffett preferring not to reinvest. Geico is not reinvested in technology. Um, Progressive has an edge.
I'll ask another question, but I wanted to bring up that let's consider these case studies, not a recommendation for anybody listening. So it's just an
Yeah,
illustration, and
just
we'll
case studies. Yeah.
let everybody do their own research and decide if it belongs in their investment pool or not. But I want to ask you about growth in general. There are moments when the market gets very excited about growth. And you quote Buffett again. The quote is that we shouldn't confuse growth with profits. There are some industries that seem to grow, but there are no profits. And it comes back every 5, 10 years or so. And we had this experience a few years ago now that we had even an index that one of the investment banks set up that was profit-free companies, so profit-less companies, which I found amusing. So they took companies with no profits and they showed how they were outperforming for a period of time everything else. Can you talk about that as we're looking for growth, as we're looking for those opportunities you talk about? We can't forget that the profit matters.
Yeah, I mean, here again, ideally you want all of the above, right? You want growth and profitability. Um, what I say in my book, though, is that it used to be, back when I started in the mid 90s, that if you didn't have profits as a company, it was probably unlikely that you were going to be profitable. You know, there was no you had to really show why, your loss was going to turn into a profit.
Mm-hmm.
And Buffett likes profitable, mature companies. What the tech boom has shown is that companies like Amazon, I think they've reported a loss, a gap net income loss for a third of their public history.
Mm-hmm.
But that doesn't mean they're not profitable. It just means that they're reinvesting all their dollars into the business. So here again, in the income statement, it looks like a loss, but really it's just a massive investment. And I talk about this for those of your listeners who are interested in accounting. The accounting that we have now was produced in the 1930s with the help of Ben Graham, ironically, and it favors industrial companies. It
Right.
depreciates a factory over 20 years.
Uh-huh.
But research and development expenses, which are, some of the main expenses of a tech company, they're expensed in 1 year. So
Uh-huh.
if an industrial company builds a plant worth $100 million, their expense in year one is $5 million, right? $100 million plant divided by 20-year depreciation schedule is 5 million.
Right.
But a tech company has to expense that whole $100 million if they invested in R&D. So the
Mm-hmm.
accounting favors the old school companies. The accounting is outdated.
Mm-hmm.
The tech companies say, to hell with accounting. We understand this is an investment. We understand there's going to be a payback. Who cares how the books treat it? Because remember, these tech companies are run by engineers. Engineers are pretty
Right.
quantified, pretty quantitatively sophisticated people. So they understand the payback. They just understand that the accounting, you know, punishes them. But
Mm-hmm.
damn the accounting, they say. Let's do what's economically correct. Sales and marketing expenses too. I say in the book, Intuit, you know, they know that if they get a TurboTax or a QuickBooks customer, that life of that customer is going to be much longer than 1 year, and that the payback that they're looking for is three revenue dollars on
Right.
each dollar of marketing they spend.
Mm-hmm.
But the marketing has to go through the financial statements as a 1 year expense. So here again, this is something that really is a capital expense that has a
Mm-hmm.
multi-year life that the financial statements require you to expense in one short year. And so
Mm-hmm.
Intuit says, well, screw that. We know that this is going to be a great payback, so we're going to invest, even if it makes our earnings, quote, look low. So all of which is to say, that there now is a huge record of tech companies that started out looking unprofitable that are now hugely profitable
Hmm.
because they understood that if they reinvested through the P&L as they scaled users, they could drop or keep steady their R&D expenditures and their sales and marketing expenses. And a flat expense line with a rising revenue line means the profits drop to the bottom line. So, but even now, Amazon keeps reinvesting,
Hmm.
and the likelihood that that will turn into profits one day is virtually 100%. And ironically, the more they reinvest, the more optimistic we should be because they're pushing out the mature days. They're pushing out the harvest
Hmm.
because they see more they see more seeds that they can plant, so to speak.
I think Amazon is in a category of its own, that the market
Yeah.
allowed them and they pulled it off for so long that they didn't have to show profits. But the other thing is that when we look at statements and numbers, and I had Jeff Gilbert on the show, who is an accountant and auditor, and he investigates frauds and he's fascinated with frauds. And we talked about how accounting is not really set in stone. I mean, there are rules, but you really have to understand what the numbers mean and how much nuance there is behind it, right? So if you look at two companies, right, one has a profit margin of 1%, the other one has 5%, you would say, well, this one is better than the other. Well, you should ask a few more questions to understand the context of how did you get to the number, and you bring it up in
That's
the
right.
book. And we'll come back to the numbers, but Adam, I'm curious about the management. Who are the people that are running the business? And I'll tell you why I bring it up. In your book, you say you want the ones who put long-term stewardship ahead of self-interest. I had Christian Billinger on the show, who runs Family Money out of London, and we talked about the soul in the game, the pride in what you do. When we buy a company, we really want to buy something that's not for sale in terms of the management who is running it. People who are not motivated only by financial incentives, but they show up and they do a better and better job because they have some sort of a higher calling. And that's what I heard reading your book, that long-term stewardship. Can you talk about it? I feel like it's harder and harder to find these days.
Yeah, percent right. And when you put that template over American, American management in particular, it calls out about 95 out of 100 managers, unfortunately. Um, it's sad, but the worst kind of capitalism is the kind of capitalism practiced by Boeing, for example. The chickens are now coming home to roost for Boeing, but that was a 40 or 50-year disaster in the making because essentially at Boeing, the financial guys took control from the aerospace engineers.
Mm-hmm.
The financial engineers took control over the aerospace engineers.
Mm-hmm.
Um, and so when that happens, they start taking shortcuts. They start trying to produce more profits in the near term, but they sacrifice the R&D budget to build the next viable aircraft 20 years from now. They say, screw that. Our bonus depends on profits in the next 1 to 3 years.
Right.
So, they buy back stock. They milk the business for cash.
Mm-hmm.
Um, it's just been a disaster, and that's the worst kind of capitalism. Making short-term decisions for your short-term benefit, and who cares what happens to the company in the long run.
Mm-hmm.
So it's a sad commentary on American business, and we need more long-term focused businesses. And fortunately, those are the only ones I look at. Heiko, the management, owns, I don't know, 10, 15, 20% of the company. Amazon, Bezos owns 10% of the company. I mean, the two things you want to look for are, do they own their company? I mean,
Mm-hmm.
sort of so simple. Are they eating their own cooking? You know, uh, and then the second thing you want to look for is, do they reward themselves with lavish expense packages, option packages, and then related to that, are their bonuses short term oriented or long term oriented? And as I say, 9.5 out of 10, pay themselves way too much money for the short-term results, give themselves options. Elon Musk is a brilliant, brilliant inventor. He'll go down with Edison as one of the brilliant inventors of all time. But I don't think I'll ever invest a dime with him because, he's the guy who he owned, I can't remember, 10 or 15% of Tesla. And he went to the board one day. He said, I need another 10 or 15% to get me motivated. And the board gave it to him. Owning 10 or 15% of the company wasn't enough. I need another slug. Um,
Uh-huh.
so that being sued, and the suit is able to go forward, and he lost a decision recently, and that's when he said, "Oh, I'm leaving Delaware and all that stuff." He's not a steward. He is
Mhm.
a self-promoter. He's in it for himself. As brilliant an engineer as he is, he really doesn't have shareholders' best interests at heart. And so those are the guys you want to look for.
It's such a powerful statement. When I'm having those conversations here on the podcast, I emphasize the idea that we as investors, we're minority shareholders in businesses. And going to
Yeah.
Omaha and sitting in the middle of the meeting that you brought up, the Berkshire meeting, I had this feeling. I wrote an article about it, Return on Kindness, how the shareholders on the pedestal here, we see Buffett and Munger as heroes and inspiration, but it's really the shareholder that's treated in a certain way. And Buffett writes about it, how he treats us all as if we were relatives or his sister and so on. But that's...
He's an example, Bogomil, of kind of the best of American capitalism in the sense that, he understands that, if he does right by his shareholders, he'll get rich and they'll get rich and
Mhm.
everybody wins. Of course, he owns a lot of stock in Berkshire, so his interests and our interests are aligned. So, you know, you don't want to overstate the what's the word, the magnanimity of a capitalist. I mean, a capitalist is in it to make money.
Mhm.
But if he's in it to make money and you make money along the way and he
Mhm.
doesn't rip you off, he treats you with fairness,
Mhm.
that's about as good as it can get.
Mhm.
And if he improves the economy as a result, better, faster, cheaper, then that's really great because then then the company that, like Heiko or Amazon, they're actually providing a benefit to society. And here again, you don't want to overestimate the sort of the philanthropic nature of it.
No.
Jeff Bezos and Larry Mendelson aren't doing this to be
Mhm.
nice. They're doing it to
Mhm.
make money. But it just so happens that they're putting the customer first,
Mhm.
so everybody wins. The customer wins, the shareholder wins, they win, they get rich, shareholders get rich, customers pay cheaper prices, get better products. A lot of these companies have employee stock ownership programs. The secretaries become multimillionaires. Society benefits because costs come down, right? Whether it's Heiko or Alphabet, all their products are free. How many billions of dollars has Alphabet saved the world with free
Right.
maps and,
Mhm.
free search, so forth. Costco is another great example, of a company that everybody wins. The
Mhm.
executives get rich, the shareholders get rich, customers get a better deal. That's the best kind of American capitalism. And those are the only companies I invest in.
There was an interview with Jeff Bezos where he said, you look at me and I have all those billions, but look at everybody else that got rich with me as a shareholder of Amazon
Right.
over those decades. And it was such a powerful statement because, sitting in the Berkshire meeting, I'm looking, of course, Buffett got rich through the process, but look at everybody else in the room. And some of the people participated in this journey for multiple decades. They all
Yeah.
got rich
Yeah.
with him.
Yeah.
And
You saw that there was a recent grant from the widow of one of Buffett's early cronies. I think she funded the
medical school.
tuition of all medical students at Albert
Mm-hmm.
Einstein School of Medicine.
Mm-hmm. Mm-hmm.
So,
Yeah, pretty remarkable. Yeah,
yeah,
it's
just from
it's a
Berkshire Hathaway stock.
capitalism, the stock market, and the shareholder are quite an invention that have allowed a lot of people to live wonderful lives, and that's the essence of what we
Indeed.
talk about here. Adam, there's a question, a critical question that you have for the CEOs, and you say that 80% of them get that question wrong. What's
Mm.
that question? Why it's so important? and you ask them about the growth in
Oh yeah, well
sales.
it goes back to what we were talking about earlier, what's more important, sales growth or return on invested capital?
Right.
So most CEOs come up through the operations ranks, or sales ranks. So they're really not financially terribly sophisticated. They've gone to business school and they've been taught how to read financial statements, but it's not their core competency. So as I say in the book, most of the CEOs that I ask the question say, "Oh, sales growth," because they
Hmm.
know that's what Wall Street wants. Uh, Whereas, of course, if you're growing sales at 1,000,000% a year and your return on capital is 3%, you're going to go belly up pretty quick. So what you want is 7% sales growth at a 20% return on capital, because then you're earning your keep, right? So yeah, I mean, it's kind of like, good managers are very rare. I mean, either they're self-interested, which we just talked about,
Hmm.
and short-term oriented for themselves, or they might be, have your best interest at heart, but they're just unsophisticated financially. So when you find someone who's a good steward of your money and also financially sophisticated, boy, you really. Should pay attention. And of course, the business has to be great too, but um, good managers are hard to find.
And I think the incentives and what they think they should deliver is not what serves a long-term shareholder. That's the challenge. They think they have to grow
Yes,
earnings per share, they have to show sales growth, and that's how their
yes,
compensation is tied. Very few people think about the
yes,
next 5, 10 years where the real value can be created, and that's a
yeah.
very different
And
mindset.
that's where culture, a company's culture, really comes into play. A company is like a family or like a nation. If you study a company, you understand that there's certain things that are valued and certain things that aren't valued. And so if you value short-term profits as a company, that's just going to seep into the mindset of the people running it. Whereas if you think of yourself as if the company thinks of itself as something that wants to grow and be around for 10, 20, 30 years, that is also going to affect the decisions. So, and here again, it's that mindset is closely correlated with CEOs who own a lot of the company.
Reading your book, I wrote down this idea that I think is the number one obstacle for a lot of us to participate in those hugely successful companies. And it's the fact that you bring up that they remain expensive all the way up.
Mm.
So if you're price
Yeah.
sensitive as an investor, you're up against a serious challenge. You might never have a chance to
Yes.
get it very cheap. There might be a break, a sell off, a drop, but it's unlikely you will get it at a low, low multiple by traditional value standards. You have a solution to it. Can you talk about it?
Well, there's two solutions, Bogomil. First is, pay up a little bit. Don't be so stingy.
Uh-huh.
So, I try to get a really great business that's really well run for 20 times or better. So,
Mm-hmm.
right, 20 times earnings is a 5% free cash flow yield day one. So, right there, that violates a few value-based standards, right? 20 times is considered expensive. The second thing is to make adjustments, and this is really the meat of the book, where I walk through how, as we've been talking, accounting distorts the true earnings of a tech company, especially, and you have to sort of back out the investments that they're making in the future to arrive at what I call earnings power. So in the book, I say that, Amazon's margin ex AWS, essentially its e-commerce margin, is 2%, and Walmart's is 6%. So and that's according to the GAAP financial statement. So if you uh, agree with that, then you implicitly agree that Walmart, which is a brick and mortar retailer with 5,000 stores, is inherently more, three times inherently more profitable than a online retailer that has no employees facing the customer, no shoplifting, no depreciation on its heavily trafficked stores. I mean, it's just absurd to
Mm-hmm.
think that Walmart would be three times more profitable. So you have to make some adjustments to Amazon's income statement to arrive at some sense of the underlying profitability. If Amazon weren't investing so aggressively in its e-commerce function, what would its margin be if it were a mature company like Walmart? And look, these are very, very difficult exercises, and I make no pretense at precision, but it's still worth the exercise. Just because you can't do it precisely doesn't mean you shouldn't try to get it in the neighborhood. So, for example, Amazon has $40 billion of advertising sales. Well, I think its entire operating profit, including Amazon Web Services last year, was $40 billion. That means the rest of the business earned nothing because
Right.
ad sales come in at 100% margin, right? There's nothing, you just put the ads on the website. So there's all these things that you look at uh, in the financials that don't make sense. So to try to make sense of the financials, you can get comfortable with what I call the earnings power that's often drastically different than the published earnings.
I like that point that not to be stingy. It makes me think again of Buffett and See's Candy when he almost didn't buy
Yeah,
the business because it was obviously at the high end of what he was willing to pay. And he was just transitioning at the time from the cigar butt companies to companies he can actually hold over a lifetime.
that's
And
correct.
second point that you bring
That's
up,
correct.
which we talked about, accounting can be much more nuanced in the way that it doesn't tell you the
Yeah.
entire story. And I think it's worth
Yes.
pondering and investigating a little bit. What do the numbers
Yes.
mean,
It's a little,
right?
it's a little specialized, but the book I think helps readers start to think it through a little bit.
You propose some
But
tools and tricks.
yes, I do in the book. But getting back to the stingy point, the thing that it's important for people who are struggling with this issue to remember is a good business that it's growing, it's going to sort of bail you out of paying a high multiple. It's going the good companies bail you out is the way I think about it, in the sense that if
Right.
you pay 20 times earnings for company X,
Hmm.
so it's selling for $20 a share and it's earning $1 a share. In 5 years, if it grows earnings 15%, it's going to be earning $2 a share. So all of a sudden, your yield on that $20 investment is now 10% yield, which is very good.
Hmm.
And so, you know, 5 years hence, two things are going to happen. One is people are going to think, oh, this is a terrible company, and I'm going to value it at 10 times earnings, in which case you will have made no money. The stock will be $20 still. Or they're going to keep valuing it at 20 times, which is much more likely because it's still going to grow. It's got a competitive advantage like Heiko, like Amazon, like Progressive, like all these companies we've been talking about. And so you will have made 15% a year. And then 5 years after that, earnings grow, they double again. And so now you've got $4 a share on your initial purchase of $20. And that's what happened with Seas. I think he paid $70 million for it, and it's generated $2 billion in operating profits in the 50 or 60 years since he's owned it. So this is what you want. You want companies like that are going to just dwarf initially your entry price. Whereas on the other hand, if you buy General Motors because it's 5 times earnings, well, 5 years from now, I, I'm sorry, but it's hard for me to envision that General Motors earnings are going to double, you
Right.
know?
Huh.
So you pay $5 a share for $1 a share of earnings, and in 5 years, maybe the earnings are $1. So, I don't know what happens to the multiple, but more likely the earnings are now 70 cents. You don't want, it's a sucker's game. It's why they call, the cardinal sin of value investing is a value trap.
Value trap.
You got to really, you good companies bail you out of high multiples, whereas bad companies put you further in a hole.
I like the visual of getting bailed out by the quality business because it gets bigger and better as you go. And I'm thinking of, Chris Mayer, 100x stocks, and Phelps did studies of what kind of a company could go 100x, but it could be 20x, 50x. And the interesting point is that traditional old school value investing that emphasizes how much you pay for something, it comes with a catch the value trap situation where you might just not get out of trouble. And in the world where we live today, the times that we have today is that the change happens so quickly that value trap can be a real serious trap sooner than we thought and deeper than we thought. I think
That's right.
that's
In this era of disruption, you know, businesses are bifurcated in the sense that either they're on the right side of history and they've crossed the digital divide and will prosper, or they're on the wrong side of history. So Macy's has looked cheap for a long time,
mm-hmm,
but it is not appreciated. You know,
mm-hmm,
AT&T has looked cheap for a long time, pays a big dividend,
mm-hmm,
stock continues to decline. So you have to be very, very, very careful about that. And you want to pay attention to the business quality. Much, you want to, business quality comes first, then comes management. If you
mm-hmm,
check those two boxes, then you can look at the price, and price is a veto. The price, if the price is too high, you just put it aside after you've done your earnings power adjustments. But you should not lead with price. It's a fool's game. I mean, think about things like real estate. Like, I'm gonna look for cheap apartments, so I'm gonna go to all the crappy neighborhoods. Why would you do that? Why? Living in a crappy neighborhood,
mm-hmm,
the neighborhood is unlikely to turn around. I mean, if that's part of your investment thesis, then fantastic. But
mm-hmm,
you know, it's it's it comes from Ben Graham, right? He
mm-hmm,
was the Moses. He gave us the Ten Commandments. And
mm-hmm,
even Buffett struggled mightily to get out of that
mm-hmm,
cheap first mindset. And you know, all I'm saying is, in the digital age, we need to continue to get out of that cheap first mindset, and we
mm-hmm.
need to widen our scope to include digital businesses, which are, um, look even more expensive than Buffett's comfortable with, but they're really not more expensive
Mm-hmm.
once you factor in all these adjustments. Not to mention all the green field they have in front of them.
The open-ended opportunity, the open horizon.
Yeah, yeah.
Adam, I'm very curious about your definition of success, and I'll ask you in a second, but I have to bring up Peter Lynch again. And his
Mm.
book, One Up on Wall Street, is the reason why we're even having this conversation today. I opened that book as a student in college and got me excited about the stock market. He said stocks are small pieces of businesses, and I never looked back. But you bring him up in your book, and you say how he shared how we all have this knowledge about the world around us as consumers. You talk about the professional experience. So you say tap into this Peter Lynch's wisdom, but you want to do it with a twist. Can you talk about that twist?
Well, yeah, I mean, he says buy what you know, right? That's what
Yes.
he said. And he made fun of people. He said, the aerospace engineer wants to buy retail stocks, and
Uh-huh.
his wife, who works in retail, wants to buy semiconductor stocks, and the
Mm-hmm.
semiconductor engineer is interested in, I don't know, industrial companies. And it's all because, familiarity breeds contempt, right? We're all sort of bored, and we all know the warts of the industry we're in. Peter Lynch says, no, 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 you have an edge there. You have an edge in your industry. And that remains the case. I'm just saying, in the book, be careful, because, what I say is, uh, older investors, baby boomers, they understand the stock market, but they don't understand tech.
Mm-hmm.
So they're liable to invest in what they know, which means, banks and retailers and oil companies, and those companies, by and large, have all had their best days behind them. Whereas younger investors, millennials and younger, they understand tech because they've grown up with it, but they don't understand markets. They've been burned by, dot-com bust, great financial crisis. These are earlier in their memory banks than older investors have them, and so they're distrustful, which is why, which is one of
Right.
the reasons why meme stocks are so popular, or have been so popular, why crypto is so popular. People think the system is generally rigged. And
Mm-hmm.
so I try to encourage people in the book, like older investors, learn about tech. You can't just buy what you know, because what you know is, a lot of it's outdated. So learn about tech. And millennials, I say, well, buy what you know in terms of buy the tech companies because you understand them in ways that older investors don't. But but learn about the markets. Like learn understand that the markets actually work.
Uh-huh.
And buying a stock is just buying a fractional business.
Mhm.
So there definitely is a twist in the buy what you know maxim.
Mhm. And I like how you have advice both for older investors and younger investors. And
Yes.
I met both, and I'm somewhere in the middle, and I catch myself when I think like an older investor sometimes, and I think like a younger investor in other moments. But
Yeah.
it's a it's a good refresher to think about the market, how it works, and that it does work. And then don't forget to continue to learn because new things will come up, and they will be
Yeah.
different, and they will work differently. Adam, before I
Yeah,
let
that's the
you,
point I make it. That's the point I make about tech, Bogomil, really quickly is, everyone's wild about AI now, and the book came out a year before ChatGPT and AI went crazy. But the fact is that AI has been around,
Mhm.
and what I say in the book and what I'll reiterate here is, you know, it doesn't matter whether it's AI or driverless cars or quantum computing or virtual reality. These things are coming, and you know who's going to benefit from them economically speaking? Multiple choice. A, healthcare companies. B, financial service companies. Or C, tech companies. Of course, tech companies are going to benefit from these things. In some ways, it doesn't matter which innovation is now. AI is now, and in a couple of years, something else will be the next hot thing.
Mhm.
But tech companies are where the innovation is, and they're where the money is, which is why we should focus on them so much.
And it's such a big industry, from companies that make actual gadgets that we hold in our hands all the way to completely virtual experience. So when we say
Yeah.
tech, it's a whole world. Adam, before I let you run and get thinking really seriously about your vacation, how do you think about success? What's your definition?
Oh, I'm kind of a middle way guy. I learned early in my journalism career that having a lot of uh, professional success doesn't necessarily make you happy. And since I've been on Wall Street, I've seen that there is no correlation that I've observed between having a lot of money and being happy.
Mhm.
Like you think, oh, the more money I have, the happier I am. But I know a lot of miserable rich people. So I want to be successful. I want to make money. I want to make money for myself. I want to make money for my clients. I want to have a good reputation. I like writing books and having people ask me questions like you about them. I think that's interesting and fun and flattering. But on the other hand, I know that if I don't have a good inner life, spiritual life, so to speak, if I don't have a good relations with my family and my friends, that none of it'll matter. All the success and all the reputation won't really make me happy. So I try to kind of split the difference.
I like the
Be
sound of that.
moderately successful in the outer world and be moderately successful in my
Mm.
personal life.
And
And I think I'm doing a pretty good job. Some days are better than others, but I think I'm finding the middle way pretty well.
I'm hearing an inner scorecard idea that also comes from
Ah,
Buffett,
yes, that's
right?
right. That's right.
Knowing
That's
exactly.
right. The inner scorecard. Yeah, you're right.
Have you read Ken Honda's Happy Money book?
I have not. I have not.
I'll be recording with him in a week or two, and it's a wonderful read. And he talks about the energy of money and things that you brought up. Very quickly at the beginning of the book, he says he was the son of an accountant, and he says my father would have people visit, rich people that were getting richer and richer with each tax return. And he said there were the happy rich people and the very unhappy rich people, and they would remain so.
Yes, that's right.
And
That's
he,
right. You really have to. Yeah, it's a really dangerous thing to go thinking that money's going to make you happy. I mean, look, I'm not here again. I'm not naive. More money is better than less money. I'm not saying that poor people are happy.
right.
I'm just saying that there's really no correlation between more money and more happiness beyond a certain point.
Mhm.
Beyond a certain point, you have to have enough money to live and be comfortable and so forth. But beyond that, the marginal utility of money is virtually nil.
There's more to
from a
it.
happiness.
Yeah, there's
There's
more to
much more
it.
to life. Yes.
Adam, this was such a wonderful conversation. Thank you so much for today. I really appreciate it.
I enjoyed it, Bogomil. Thanks for the good questions.